Hey, Mark Lund here, author of The Effective Investor, and I wanted to send out a quick video regarding the Dow's toughest day since December 2008. On his 50th birthday, President Obama watched Wall Street cast a no-confidence vote in the economy he had been assigned to turn around. The Dow Jones Industrial Average sank 512 points and experienced a correction Thursday, with the S&P 500 down 60 points, NASDAQ down 136 points, also down more than 10% from spring peaks. So developments overseas generated anxiety on Wall Street, citing renewed tensions in some financial markets. In the Euro area, the European Central Bank abruptly announced a bond buying program Thursday, a distinct reaction to fears that Italy or Spain might need a bailout from the European Union. ECB President Jean-Claude Trichet, I hope I got his name right, say that downside risks may have intensified. The ECB didn't detail the debt securities it would buy or the amount of the purchases. Early indications hinted that the campaign would be modest. The ECB broadened the scope of its lending to Eurozone institutions at its benchmark interest rate this week in a move to aid feebler banks. The Bank of England kept its key interest rate at 1.5%, and the ECB held its key rate at 0.5%. These firefighting moves did little. The FTSE 100, CAC 40, and the DAX all dropped between 3.4%, 3.9% on the day. Japan's central bank sold 1 trillion yen Thursday on an effort to weaken the currency while also announcing an increase in asset purchases. This move followed the Swiss National Bank's Wednesday decision to reduce interest rates to near zero to try and weaken the Swiss franc, which had climbed 10% versus the euros in July. The dollar went 2.3% higher against the yen on the day. Treasury prices rallied. The yen of the 10-year note went down 15 basis points to 2.4, the biggest descent since June 2010. The 2-year note yields fell to a new low of 2.26% on Thursday. So stateside headlines aided the market's descent. JP Morgan scaled back its Q3 2011 U.S. growth forecast by 1%, and Bank of New York Mellon said it would begin to collect fees from large depositors, which had affected its capital ratio. The Labor Department announced weekly jobless claims and slightly decreased to a seasonally adjusted 400,000, basically unchanged from last week. Wall Street also had Friday's unemployment report on its mind. General Motors said its earnings had almost doubled, and Kraft Foods announced a split as well as results that topped estimates. But these positives mattered little on Thursday. Of course, other recent news items were still on investors' minds. The disappointing U.S. GDP from the first and second quarters, the underwhelming July PMI readings from the Institute for Supply Management, the about-face in consumer spending in June, and the particularly poor showing of July's final Reuters University of Michigan's Consumer Sentiment Survey. At a time when bullish sentiment is being severely strained, it is worth accentuating the positive. Bloomberg data indicated that 77% of S&P 500 firms had surpassed average profit forecasts of analysts in this earnings period. The S&P 500 was trading for 3.8 times reported earnings on the day before the correction, the cheapest level in 13 months. Barini Associates data notes that the average bull market since 1962 has lasted about 49 months. The current one is about half as old. In the past 39 years, 25 corrections have occurred in bull markets, and just 9 have led on to bear markets. On average, these corrections have lasted 118 days. That's history, not the near future. Yet while the future is unknown, we can recall that last year's correction did not send Wall Street into a bear market. Remember your time horizon. Look long term and don't get caught up in the short-term movements in the market. That's it for today, and have a great day.